right, y'all. Erica Neal, Infinity Investment Strategies. So let's talk about today. I work with a lot of real estate investors and business owners, but I'm going to talk specifically to my real estate investors today. And I wanted to bring up something that a question we get all the time: self-directed IRAs and infinite banking. What's the difference? And pause for a minute. You guys know my philosophy, okay? There's no such thing as a good tool or a bad tool. There are just different tools that do different jobs. And self-directed IRAs are no different. They do serve their purpose and they have a role to play in different people, right? It makes sense for some people. But I wanted to bring up today some key differences between these two different types of accounts, because there are hurdles, there are problems that I have had clients face that we have helped them solve by transitioning from a self-directed IRA to a infinite banking policy, especially as it correlates or as it pertains to real estate investing. I'm sorry, my mind just went totally blank. Okay, I haven't finished my coffee yet, so we'll hopefully get better as I go. All right, so let's talk about the differences here between infinite banking when it's compared to a self-directed IRA. So the first thing I want to point out is, when we're talking about self-directed IRAs in real estate, here we go. Infinite banking, self-directed IRAs, real estate. Here we go. So first option is guaranteed growth plus dividends. Yay in infinite banking, nay in self-directed IRAs. So what this means is self-directed IRAs do not have a guaranteed growth element. They just don't. Infinite banking policies, when they're designed correctly, we are using A-rated, mutually owned, dividend-paying companies with a whole life policy that are guaranteed to grow every single year. Now, what this means is I'll go into that in a minute. I want to point out something real quick. This is called infinite banking. You see this word right here, infinite banking. You know what it doesn't say? Infinite returns or infinite investing. That's not what this is about. Okay, so many people I talk to are like, oh, I can go get a better rate of return in the market. Yeah, you could. But that is not what this is. I would never tell somebody, oh, hey, put your money into this IBC policy because then it's going to get you the best rate of return ever. That's not the point of this. This is an alternate bank that you're using to hold your cash so that you can then use to go out and invest in whatever asset class you want. Here's the thing. If you're looking at infinite banking purely, right, through the lens of actual banking and not just trying to get the best rate of return, and you use these guaranteed growth plus dividends policies, that means when the market goes up, your IBC policy goes up. When the market goes down, guess what? Your IBC policy still goes up. Now, when does most real estate or any buying opportunity tend to present itself? When the market's down. So if your liquidity and your cash is also tied to the market, that means you're going to have to lock in losses just to go capitalize on whatever opportunity you have. Infinite banking policies are our opportunity fund. They should be there to strike, right? As we say in Texas, get while the getting's good. We want to strike while the iron's hot and get our cash to go capitalize and take advantage of whatever opportunities we have. If we are losing money in order to do that, that's going to reduce returns. Now, IULs, I get that question all the time. Can I do infinite banking with an IUL? I mean, is it infinite banking? No, it's not a true infinite banking policy. But can you bank on an IUL? You can, yes, technically. And again, there's no good or bad tool, but there are certain things that we need to be aware of and how they actually function. And the big feedback I get is, well, an IUL has a floor of 0. Absolutely. And that's one of the best things about them. But think about this. We're going to talk about it here in a minute. When you are doing infinite banking, what you're doing is you're going to your policy and you're saying, hey, I'm going to borrow, right? I'm going to lend this money out. I'm becoming a banker. You borrow your money. You borrow against your money to go out and invest in XYZ asset. So when you take that loan against your policy, you're paying a simple interest rate on that policy loan. Okay. Now, the reason we're doing that is because you're still earning interest inside of the policy. You're earning guaranteed interest plus dividends. So by creating arbitrage, right, when you're doing that, you're creating arbitrage in that you are earning more interest than what you're paying on that policy loan, creating a net positive arbitrage, and that's going to increase and add on to whatever returns you're earning inside of the outside investment that you've made, okay? Now, if this is within an IUL, what happens is you can still borrow, you can still loan, right? You can still take out that policy loan. You're still going to pay simple interest on that loan. Now, if that cash is tied to the market and the market goes down, yes, you have a floor of 0, but 0 is still not earning anything. So what that means is you're paying simple interest and you're earning 0. So that is a negative arbitrage, which means you're reducing the return on that outside investment. Now, could it go the other way where the market goes up and you earn more? Absolutely. But again, that's a gamble. That's just something that we want to make sure and point out to people. I'm not throwing stones. I'm just being realistic on what's actually happening behind the scenes. Now, IULs aside, doesn't matter. Self-directed IRAs, they do not have any element of guaranteed growth or dividends that you're going to be earning. Okay. Now, do you have full control and access to your funds? No questions asked. In an IBC policy, yes. Self-directed IRA, no. I always kind of make the joke that the R in IRA, do y'all know what that stands for? Restriction. I'm just kidding. Kind of, but not really. So there are a lot of restrictions on IRAs, right? You can't put it into your own deal. You can't do this. You can't do that, right? So there's a lot of guidelines that you have to fall into when you're using money in your IRA. You do not have just full access and control. Within an infinite banking policy, you can take out that cash for whatever you want. So we have clients that do multifamily. They want to invest in their own syndication, or maybe they have a single family portfolio or Airbnbs, and they bought this property, but now the air conditioner's gone out, or I need to do a remodel, my roof, water heater, right? There's always something that goes wrong. It's going to happen. So you have the ability to go and access your cash and do whatever you want with it. I mean, you can go to Vegas and put it all on black for we care. It doesn't matter, right? Like the point is, we're talking to a client right now about using it for his kids' braces. So the point is, it's inside of your policy. You're the banker and the borrower, so you make the rules. You have full and total access to that cash. Now, opportunity to take advantage of cost segregation depreciation, any depreciation, okay? Straight line depreciation, cost segregation, bonus depreciation, all of it. Do you have that in an IBC policy? Yes. IRA? No. So what happens is when you invest in real estate specifically with an IRA, you forego any and all depreciation that's available. I'm going to tell you right now, this one irritates me a little bit because one of the biggest reasons to invest in real estate is the depreciation. In fact, you guys know, right, that when you invest with a self-directed IRA, that investment is made in the IRA's name, not yours. It is owned by the IRA, okay? So you are not the one investing. The IRA is investing, and the IRA takes no depreciation, okay? And one of the first things I was asking many years ago when I was getting into this, I'm like, well, if they don't get the depreciation, does it get redistributed amongst the other investors? No, it just goes thin air. It's all gone. So when you're investing with an infinite banking policy, it is treated same as cash. The loans are private. Nobody knows that they exist. So when you take those loans out and you go invest, that is treated same as cash. So you're going to get to take advantage of any and all depreciation that's available. You can use that, okay? Now, can you invest your funds while your funds continue to earn interest in the account? IBC, you can. IRAs, you cannot. So what is this saying? This is coming back to what I mentioned earlier with the guaranteed growth and the loans and the earning, okay? So here's what's happening. If you invest with an infinite banking policy, okay? Well, let me back up. If you're investing with a self-directed IRA or even a bank account, you're just doing traditional withdrawals, which means if you have 100,000 and you want to take out 70, you take out that 70, you go invest that, and you're getting whatever rate of return you get, okay? Inside of your IRA or your bank account, you're only earning interest on the 30,000 left over. That's just what it is. Most people are familiar with that. However, if you have become your own banker, what's happening is that 100,000, you now have it inside of your IBC policy. But now when you take out that 70, you are the banker, so you're actually going to take it out as a loan because you understand leverage, you understand arbitrage, okay? So you actually take out that 70 as a loan, and when you take it out as a loan, you're going to pay simple interest on that loan. Here's what's technically happening behind the scenes. You go to the insurance company and say, hey, I want to take out a loan for 70,000. They're going to say, hey, Mr. and Mrs. Customer, we see that you have 100,000 in your cash value. So what we'll do is we'll lend you $70,000 from our pocket. You're borrowing the insurance company's money. They loan you 70,000 and they put a lien against the 70,000 in your cash value. So you can't go reborrow it, but it is still there earning compounded. So you're, again, recreating what the banks do. You're using OPM, other people's money, to go out and get a rate of return. So you're paying simple interest on that policy loan back to the insurance company, but you're still earning compounded on the full value of your 100,000 at the same time. So you're doing what Robert Kiyosaki says in creating giving $1, multiple jobs. Okay. And all of that, again, that kind of comes back to why do we want to have guaranteed returns and dividends? And, we can dive deeper into that later. But IBC, using it this way, leveraging those dollars, you are earning interest on your money even when you go out and invest in alternative assets. Okay. Now, inside of the policy, do you have privacy and protection of your assets from creditors and predators? So, infinite banking? Yes, you do. IRAs? No, you do not. So, if you have an IRA and you have a creditor that's coming after you for a bad loan, or, I don't want anything bad to happen, foreclosure, right? Like, things happen. It just does. Especially right now in today's environment, it's not going so hot for very many people. But the point is, if you have a creditor coming down the line, whether it's on a business or professional end, they can start to put pressure on you and start to take your assets. Okay. Same thing from a predator standpoint. Predators, right? This is a sue happy world. Everyone's always out there looking to sue somebody. So it could be a clumsy tenant, could be an angry investor. Maybe you partner with the wrong person and they break the bad boy rule, right? It could be something that's silly, like my daughter's going to start driving this year. So it makes me nervous. So if she were to, or even me, right? If I rear in somebody and their neck hurts a little bit too bad, they can sue me, my house, my car, my dog. They're coming after anything and everything. But they cannot sue and cannot come after the assets that I have inside of my IBC policy. Now, I will say the protection on this is going to be state specific. I live in Texas, so I'm specifically referring to that, but I have clients in every 48 of the 50 states. So I work with clients all over the US. So we can have a conversation one-on-one on what your state and what your situation allows for, but the minimum protection level is 50%. Okay. So anywhere between 50 and 100, again, any protection is better than none. We have all these different firewalls, right? We have LLCs, we have trusts, we have all these things built in to protect us as much as we can from these, what we call wealth eroding factors. And these IBC policies are no different. They create one more barrier of protection for us, our assets, and our family, so that, again, if we have creditors or predators coming after our dollars, our savings, or our liquidity, they cannot seize it. They cannot access it. Okay. Now, if you go collateralize your cash value with a bank, that's on you, but they can't just come down the pipeline and take it away from you. Okay. Now, tax-free payout to beneficiaries. Yes, on an infinite banking policy. No to a self-directed IRA. So what that means is, when you graduate from this world, the money you leave behind in a self-directed IRA will be taxable on the next generation. Okay. Now, can you do an inherited or a stretch IRA? Yeah, but I will tell you right now, I have worked with and talked to the recipients of those IRAs, and they are not incredibly thrilled, right? It's kind of a pain in their butt. The IRS is only going to let you defer these taxes for so long. Okay. And I want to emphasize that IRAs are a tax deferral. This is not a tax deduction. Those are two very different things. Okay. So when you're deferring those taxes, the IRS is only going to allow it for so long. And with that being said, they will come after the next generation and impose income tax on them whenever they receive those dollars. Okay. Now, infinite banking is built on a life insurance chassis. So those death benefits, when they're paid out to beneficiaries, are completely tax-free. This is one of the most efficient ways to transfer wealth from one generation to the next. Now, I have some people, here's the thing, everyone's different on death benefit, right? Like, oh, I want to leave my kids a lot. I want my kids to have nothing, whatever. Okay. It's up to you. Doesn't matter. The point is, there is a death benefit with life insurance. If you don't want your kids to have anything, that's fine. You can, put it into a charity, right? You can have the Mr. and Mrs. Customer Library. I don't know. But the point is that death benefit, when it pays out, is completely tax-free. There's no inheritance, no estate tax, no wills, no probate. It's just a clean cut transfer. This is how the Rockefellers have been able to maintain generational wealth for over goodness gracious, over 100 years. Y'all excuse me. Allergy season in Texas is just insane right now. So tax-free payout to beneficiaries, completely tax-free through the infinite banking scenario. IRAs do not have that benefit. Now, let's talk about what infinite banking doesn't have. They do not have income limits on growing money tax-free. IRAs do. Okay. So IRAs have limits on contribution, right? How much you can put in, but there's also income limits, meaning you can't, if you earn too much money, okay, if you earn too much money, you will not qualify for something like a Roth IRA. Okay. Now, I don't really like this term, but infinite banking has been referred to as the quote unquote rich man's Roth, right? Now, rich is a relative term. Okay. But the point is that if you earn too much money, if you have an income that's too high, you do not qualify to put money into a Roth. And it's a phase out over time. So less and less you're able to contribute. Even if you can, even if you do fall within the income limits to be able to contribute to a Roth IRA, the amount that you can put in there is extremely limited. So you're only able to put like, what is it, like $6,750, like $6,000 or $7,000 a year into a Roth tax-free account, right? An IRA. So here's the thing, like, let's just kind of pause for a minute and digest this, right? So you're telling me that if I make too much money, I can't put money into a post-tax or a tax-free account. And even if I do qualify, I can only put in this amount. Well, why do you think that is, right? The government's not stupid, right? They know what they're doing. The IRS is not a fool when it comes to collecting money on taxes. Because on the other end of the spectrum, oh, I can go open like a 401k and dump tens of thousands of dollars, right? If you're over the age of 50, you can put like $54,000 a year into a tax deferred account, okay? That is not by mistake. They know that by kicking the can down the road, you're doing a couple of things. Number one, you are allowing yourself to be in a position to have a higher tax bracket later on, because let's be honest, our tax bracket's going down in the next 10, 20, 30 years. No, it's not happening, okay? Number two, are you going to be making less money in 10, 20, or 30 years than what you're making right now? I'm not, right? If I'm making less money in 20 years than what I'm making today, I did something wrong. Right. And I'll tell y'all again, I come from the retirement planning space. I cannot tell you how often I preach that. Oh, when you get into retirement, you'll be making less money. Screw that. Why would I want to be making less money in retirement? Like, I didn't work this hard for this long to live in poverty for the rest of my life. No, like, I want to be living my best life, having a good time. Right. Y'all know me. I love gardening and I love dogs. So I want to have a big old garden with a bunch of dogs and enjoying my life. So the point is, you're not going to be lower tax brackets because tax brackets aren't going down. Your income is not going to be lower. I don't care, right? And if it is, I'm sorry to hear that, but that is not my plan. And most people would agree they want to be living a good life in the future. So the point of this is infinite banking does not have an income limit on being able to grow your money on a tax-free basis, okay? So a couple of things. Number one, is there a limit to the amount of cash you can put in? Yes, technically, right? There is the MEC limit with the IRS. We'll talk about that in another video, but that maximum is different for everybody. There's no real limit. It's all based on how much you earn, your economic life value, and how much you're putting in. But the point is, there's really not a limit to it, and it doesn't matter how much money you're making. I'll be transparent with you guys. I have been blessed enough that I have worked hard on my career and I've built this business and I've done real estate investments and all these different, a couple of different other investments that I have been blessed enough that my income, I do not qualify to put money into a Roth. I don't qualify for it, but it doesn't matter because I'm growing my money on a tax-free basis by being able to fund my IBC policy. Okay. Now technically these dollars are tax deferred, but again, we'll talk about how the money becomes tax-free when you get into a retirement phase later. The point is, I'm growing money and I have zero intention of paying taxes on it in the future, whether I'm using it to invest or I'm using it as cash flow. Okay. Now, exposure to UBIT. If you don't know what UBIT is, good. But there is what's called an unrelated business income tax. Okay. Infinite banking, there is no UBIT, no tax filing of any kind, no IRS filing. This is a private account. Okay. There's no IRS reporting. There's no tax filing, no nothing. Okay. You don't have to disclose any of it. It's nobody's business. Now on an IRA, on the other hand, essentially, right, there's a lot more to it. I'm not an IRA specialist, but basically if you make too much money outside of the IRA, then there is an unrelated business income tax that can be imposed and put onto your IRA that your IRA will have to pay. So it's an additional tax, which is kind of funny to me because this is supposed to be a tax deferred account. But anyway, I'll get off that pedestal. So IRAs, if they make too much money outside of the IRA, there's an additional tax or fee that is imposed on the IRA that they have to pay. And that actually obviously reduces the amount of returns that you're getting or what's able to be held within the account. So those are just a couple of things to be aware of. They're not private. There are additional taxes imposed if you have too much outside of that. But again, this is not to bash IRAs. By no means. I have seen people use them successfully. I've even seen them use them in conjunction with infinite banking policies, not an either or. but it is important to understand the differences between a hammer and a saw. These are two different tools that serve two different functions. So I wanted to make sure and kind of comb through a couple of things on here, just to kind of, give some clarity on what the differences are. But we'll go ahead and wrap up with this. Obviously, there's many, many more. Okay. But, just for the sake, that's just kind of a high level overview of what that looks like. But we will talk more in detail on some of these investment scenarios and benefits of IBC. So two things. One, make sure that you stay subscribed. And two, comment. Let me know what you want to know about. What are you not clear about? What are some other areas or thoughts or ideas or strategies that you want to see as it pertains to infinite banking and or real estate? I'll tell you guys, I do not know everything about real estate. However, I know a lot of people that do. So if I don't know it, I'd love to bring somebody on that can teach and tell you more about what you want to know. So we're here to teach, we're here to educate. So yeah, that's it for today. Again, Eric and Neil, Infinity Investment Strategies. Your opportunities are endless.